Good morning, and welcome to the 22nd meeting of the Latin American Shadow Financial Regulatory Committee. 24th? We made a mistake in the statement? Oh, that's not the statement? Thank you. Sorry, 24th. Pablo is always here to save me from mistakes. As a group, many of you know us, but for those of you that don't, we are a group of independent Latin American economists that have been dealing with issues relevant to the region, either developments that take place in the region or that takes place in the international context and have an impact on the region. For starters, let me present the people that are with me today, although they really don't need presentation, but still Guillermo Ortiz, which is actually a new member of the committee. Before he was, not because we have not been thinking of him in the past, but he was the president of the Central Bank of Mexico, and because of our independence rules to become to the committee, only now he can join us. Carmen Reinhart, which of course you all know, which is now at the Peterson Institute, before at the University of Maryland, and well known for her long life work on debt crisis and the like.
Latin American and American economists.
Okay, that's correct. Yeah, I'll put the emphasis on the Latin. Guillermo Calvo, which, of course, again, you all know, a professor at Columbia University now, but have taken previous positions at the high level in the IMF, at the Inter-American Development Bank, and have been advisor for countries all over the world for so many years. Pablo Guidotti, now professor at ITELA in Argentina, also with very high-level positions in Argentina, both at the Central Bank and at the Ministry of Finance. Pedro Carvalho de Melo, also a professor now in Brazil, but a former supervisor of capital markets. Let me put it in that way, both in the private and in the public position. And Roque Fernandez, former Minister of Finance and President of the Central Bank of Argentina, now at SEMA, also a professor. And maybe you would like to talk to him about his passion for science and biological reproduction of animals. It's very interesting. I mean, we have great dinners with him telling us his stories. Okay, we are not all the members of the committee. There are more members. We never are all together, but there are other people like Roberto Sale or Ricardo Hausman, but you can find the list of all our members. Alberto Carrasquilla, which actually joined us, was with us until yesterday. Alberto Carrasquilla, as you know, was a former Minister of Finance in Colombia. So we are well diversified, and well, let's see if we work well. Let me start telling you that over the last years, we're called the Shadow Committee, right? Shadow. We've been shadowing the evolution of the global financial crisis over the last year and its impact on Latin America. Back in 2008, we put forward a proposal at the time where nobody knew where to go. We put forward a proposal to recycle back to Latin America dollars that were flying towards the US, and suggested that the IMF should take a central role in that recycling process. Months after that, the proposal was not needed to be implemented, even though was very seriously considered, was not necessary to be implemented because the IMF actually came with the flexible line of credit. I don't want to get into that, but there was a number of measures taken, but we were really trying to put forward suggestions to deal with the problem there. In 2009 and 2010, we've been following the unraveling of the crisis. We have discussed in the past, in those 2 years, how the problems move from the U.S. banking crisis and the private debt problem in these countries to the sovereign debt crisis in Europe, and now the recognition that sovereign debt problems in the U.S. are also emerging. So what we've been doing is we've been shadowing that evolution, and we are still there, right? I mean, we clearly we are not out of any form of global crisis yet, and that's why we are following this line. Over this last weekend, this group took a stock again, and we concluded that pressure from the north continue mounting, affecting the financial stability of the region. But we also notice that the region is not doing everything it can to deal with those pressures. Just see what happened yesterday. There was bad news in the unemployment figures in the U.S., and that had consequences for the stock markets in many countries, and it affected Latin America too. But at the same time, there was also bad news on the political side in Peru, right? A populist candidate won. As you know, the stock market crashed. It closed. Well, you know the story. But it also had some contagion effects to the rest of the region. The issue is that both external and regional factors are combining to affect the region that is still very, very vulnerable to any little new development that affects the region, either in the country or coming from the north. So in that context, how do we describe now the global setting where Latin America is operating? Basically, what we see, and I'm going to go very briefly on this, we see basically huge unresolved problems in the US and Europe, whose resolution, and this is the important part, whose resolution we do not foresee in the coming month. In the US, we see mortgage debt overhang, which is constraining consumers' capacity to spend, and this will keep economic growth in this country low for a protracted period of time, okay? Moreover, we also see that the increasing US public debt is also constraining the use of fiscal policy to support employment. And we think that the US policy is going to continue relying mostly on monetary policy. And so we will not be surprised to continue seeing negative inflation surprises arising in this country. In Europe, and I'm going very fast because you have the statement, it has been distributed, right? So you can read it at your leisure, but I just want to get to the major point. In Europe, we don't like what we see. We don't think that the current strategy of dealing with Greece is working. And we think that either there is going to be a debt default in Greece and perhaps other countries in the Eurozone, or an outright bailout by the Eurozone, by the European Central Bank. Now, given the large presence of foreign banks in the region, we think that whichever way these developments start taking place, that's going to have effect on Latin America, and we will be shadowing those events. The problem of these events is that in this baseline scenario, okay, where the US continues being supported basically only with monetary policy, with the European problems continue. Under that basis scenario, we think that there is going to be a continuation of capital inflows to Latin America. Okay? That's basically what we see. The problem is that they are very volatile, as the example that I gave you regarding what happened yesterday. In the past, we have studied and we have presented to you different effects that these capital inflows have had on the real exchange rate, on the currency wars, of course related, and what the central banks, different alternatives that the central banks could take to contain those appreciations. This time, we are more concerned about what these capital inflows are doing to the formation of bubbles in credit and in asset prices. And the reason for our concern is that we think that there are two factors moving on. One on the cyclical side, which is the capital inflows, but we also think that there is a big constraint in the region coming from the very low savings rates. Okay? If inflows were going to reverse for a second, there is no other way to go. Okay, there's no domestic savings that is going to make up for foreign savings coming into the region. Moreover, the problem is that there's not sufficient instruments to absorb those capital inflows. Capital markets in the region are very shallow, and so they always go towards a very limited number of assets, pushing the prices of those assets up. Okay, so our recommendations this time are very focused on basically what can be done in the region, because we've been saying a lot. Okay, the U.S. should be doing this, Europe and the IMF, whatever. Okay, let's focus on what the region can do to deal both with these two issues. Okay, the cyclical components on the credit booms and the structural problems of savings. Okay. We have in the statement very clearly marked recommendations. I'm just going to kind of name them, and then I'm going to let my colleagues to expand in whichever recommendations they think. Okay. We like the fact that, let me first start with the credit booms. We like the fact that the international community has considered and is suggesting higher capital requirements. Basel III is including countercyclical capital buffers. We like that. We support that, but we think it's not enough. First of all, in what is regarding Basel III, we need calibration, estimation of what those requirements should be for the region, as opposed to what is written down in Basel III. Basel III gives you numbers, okay? We don't think that we should just take those numbers and apply them. We should consider what is relevant for the region, number one. But also, and perhaps even most importantly, what is the problem in Latin America? The problem is this very sharp expansion in credit growth. So far, measures being taken to contain credit growth have not been working. So we are now considering adopting explicit credit growth caps, directly going into credit, okay? Rather than let's go to capital so that banks have less, by having more capital, they can increase credit less. We're saying let's go directly to what we think the problem is. So we are suggesting the application of credit growth cap as kind of a maximum target applicable to the yearly increase in bank assets. This would need to be thought further, right? I mean, these are just the first step in making this proposal. I mean, we only had a weekend to get together on this. Also, what we have found is that non-deposit funding by banks is very volatile, especially external funding. So we would like to propose maturity and currency mismatch limits to external funding. Okay? I mean, we basically think that the most stable source of funding is domestic funding for banks in Latin America. A recommendation that is not new, but we want to emphasize, is the size of off-balance sheet activity of banks, especially because many countries in the region do not have sufficient supervisory power to actually be able to disentangle the complexity of off-balance sheet activities. Yes. I start in the first part of my presentation, I mentioned the importance of foreign banks in Latin America. Many of those foreign banks are European banks, as you know. So how do you deal with the issue that liquidity, if there are problems, say, in Spain or in other countries that have large presence in Latin America, actually, what if the home country, the bank in the home country has significant problems and may think that the subsidiary in Latin America is very healthy? How do you, without violating international regulations, without violating trade agreements, without violating the lack of discrimination, what can you do to prevent that foreign banks take assets, from the good subsidiary to help the bank in the home country? Well, What we suggest is the use of, in normal times, when we see that there is no problems, that liquidity requirements should be the same across the both domestic and foreign subsidiaries. However, supervisors in Latin America should have the capacity, the ability to implement supplemental liquidity requirements on branches and subsidiaries of foreign banks in the event that conditions in their home offices should be subject to a material adverse change. Okay? So we really need to find a way to protect the stability of the local banks. There are other suggestions on that, but let me move on to savings. I said that we were going to focus our recommendations both on what can be done to control the expansion or emergence of bubbles, as well as what helps to fuel them, which is the lack of savings. Well, there is so much discussion in the literature about, what comes first, savings or growth or whatever, and there's a lot of that. As opposed to focusing on that, we start thinking a little bit towards tax measurement. What is the tax structure actually doing in Latin America? And we think that there is a number of, the tax structure actually provides excessive incentive for indebtedness. And so, in order to increase the savings rate in the region, we are basically suggest that the existing tax code should be revised to eliminate any pro-debt bias. And we have some examples. For example, and that's the advantage of having a multi-country group. For example, in Argentina, the current tax codes provides an outright subsidy to borrowing by making interest payments exempt from income taxes, while interest payments are tax deductible as an expense. Also, in many countries in Latin America, the same practice used in the US is followed, which is to treat interest payment of mortgages as deductible from income tax. We don't like that. We are very aware that we don't want to prevent low-income people from having houses. So, of course, you will have a minimum deductible, and from then on, you apply the non-exemption category. But we see that in the tax code itself, there are many characteristics that actually motivate or induce over-indebtedness. We don't want to be looked at as if the recommendations that we are putting forward should just be considered in isolation. Countries differ significantly. Every time during this weekend while we were discussing, somebody will say, but this is not happening here. This is not happening in this other country. So clearly, whatever recommendation we make needs to be take into account of the particular context of the country, but these in general are what we agree. So going back to our first question of whether the uncertainties in the north are seeding a new crisis in the south, basically what we are concerned is the credit booms and large current account deficits that are being formed right now, that if they continue could be fueling into the potential formation of a crisis. However, in the next coming months, we do not see a crisis in the region. It's strong enough at this time as for us to put forward, not because we see these problems arising, we want to be alarmists and say, oh yes, given all these things, yes, we're having a crisis coming up. That's not true. We shadow what is happening. Maybe next time that we come, we'll tell you, okay, it pushed so much that now we have a crisis coming. But no, we don't yet have a crisis coming, but we think that the region has a duty now to make, and that's what recommendations have been focused on. So now, having said that, let me open to whoever wants to complement here in the panel. Pablo?
Let me maybe complement a little bit what Liliana said. And maybe I think we have two main preoccupations in mind. In a certain sense, this decade has been a very good decade for Latin America, and one of the factors that have made the region resilient in general to foreign shocks have been the perception that things had been different than in other decades, and in particular, for instance, that the region had very high external liquidity and had surpluses in their current account. Okay? So when we see what is happening currently in the region, we are seeing that the process is one that goes back to the dependence on foreign capital. And all the countries are rapidly moving into deficit positions. And we know that in the event these capital inflows stop, then that actually increases very much the scenario of volatility. The second preoccupation has to do with the fact that the effectiveness of policy in dealing with capital inflows has been relatively weak. And what we see around the region is a series of uncoordinated responses that go from foreign exchange intervention, capital controls, sterilization, and some of these measures actually shift the problem from one country to the other and do not solve it on a regional basis. So especially when we propose I think a relatively controversial measure, that is the credit caps on the growth of the assets of banks. In a certain sense, what we have in mind is if we are going to attack the effects of inflows on credit booms, then let's do it in the simplest and most direct manner, instead of trying to sort of throw a lot of measures that we sort of try to define as macroprudential and in the end do not, or just imperfectly influence the situation. So in a certain sense, I think in my mind at least, I would like to differentiate what is truly macroprudential, which goes to risk management at the bank level, and what is a macroeconomic objective, which is contain or reduce the speed at which credit growth in the economy. And so these caps on credit growth or on asset growth, I think, might be very useful to actually relieve a lot of pressure on other elements of policy. At the same time, I think one has to worry about if one contains, of course, in Latin America, the banking system is the largest channel in which credit enters into the economy. However, if one contains the banking system, of course, there are spillovers to to the capital market or to non-banks. And in this, I think the recommendation of increasing margin requirements, use that as a counter-cyclical measure, I think it might be very effective, and also goes to the fact that if you have the development of asset bubbles, in fact, the collateral requirements may be based on asset values that are not actually consistent with fundamentals. So as long as you increase these requirements, it might contain the effect of inflows on asset prices. And again, these are sort of fairly easy measures that the central bank or Securities and Exchange Commission, the version in Latin America, might actually apply.
Great. Guillermo, you wanted to say something?
Yeah, very, very briefly, to reinforce what Pablo said. If you take this without out of context, we might sound paranoid. I mean, after all, funds are coming into the region, we should celebrate, and that's good news, obviously. We all are crying for rebalancing and so on. So this is happening now. This is good news. The thing is, though, that as we saw yesterday, so that's very important to highlight, the markets are still very nervous. So a small noise here and there has a very big impact on the capital market, on spreads and so on. So we feel that there is a lot of room for contagion, especially when the banks are involved. Contagion could be very costly. Banks, in the sense, I mean, there could be banking problems outside the region. In Europe, for example, that might may produce some sort of liquidity crunch in the north. That, given the strong presence of foreign banks in the region, that could have an impact. Now, that's not only a theoretical possibility. We saw that happening. I was very shocked by the Chilean, the impact on Chile of the Lehman episode. Chile is a country that everybody recognizes as following very prudent policy, macroeconomic policy. And however, when you look at the flow of credit, domestic credit in Chile, it really collapsed in a very big way. Actually, compared to the history of those flows in Chile, they collapsed by more than around 3 standard deviations, which is one of the largest collapses in the region. So that shows that, that the fundamentals, of course, are going to be important, but there are these financial issues that we still don't understand very well, and they are at the top of the current event. When you couple that with the other point that Liliana and the report highlights, which is that the region is a low-saving region, very quickly the region is going to become, through this rebalancing process, again vulnerable to sudden stops. And we are seeing it already. When you look at the WIO numbers, the current account deficit for the region is more than 2% now. Thank you.
The other.
Very briefly, perhaps the most remarkable stress test that the financial systems in Latin America have endured is precisely the global crisis. It is remarkable that not only Latin America, but none of the emerging markets that had a crisis in the 90s, starting with Mexico in 94, then the Asian crisis, Argentina, Brazil, Turkey, you name it, none of these countries had a true financial dislocation, internal financial dislocation as a consequence of the global crisis. It is true, as Guillermo was saying, that in some countries, including Chile, also Mexico, we had a strong reduction in credit. But that was, the causes of that are difficult to pinpoint. It was, in the case of Mexico at least, the cause was not I would say, a reduction in foreign financing to the domestic banking system. In fact, as you may recall, the Fed offered swaps not only to European banks, which did have a dollar shortage because a lot of European banks were funding themselves in the interbank market in dollars. They had important assets denominated in dollars. But it is remarkable that none of the countries except Korea, none of the 4 countries, Brazil, Mexico, Singapore, and Korea, except for Korea, the other countries practically did not use the Fed swaps. So the reason why the markets, the credit markets collapsed in Chile, I think, and also in other parts of it had to do with a contagion of risk aversion. More than the sudden stop, let's put it that way, of foreign credit to the banking system. I think the banking systems in the region have been relying much more on funding in the domestic market. It is something that the report emphasized that we should continue. Lastly, let me reinforce the basic notion that given productivity differentials, given growth differentials, given the legacy of the crisis and the fiscal crisis that is affecting the developed world, including the U.S., Europe, and Japan, and the fact that pension funds, for example, in the developed world, have only a very small proportion of emerging market paper, like 3% or so. The trend towards capital inflows into emerging markets, including Latin America, is a secular one, structural one. That means that countries eventually will have to allow their currencies to appreciate. Big stumbling block, of course, is China, for Asia and also for other Latin American countries. But I think that the fundamental point is one that Liliana was emphasizing, which is the development of deep and liquid domestic capital markets. I think this is a crucial point. We have to not only be for reasons of utilizing better those capital inflows, but also we should be very mindful that the measures that many of these our countries are taking to deal with a problem of excessive asset appreciation, including exchange rate and other assets, should not interfere, or should interfere in the least possible obstructive way to the development of domestic markets. To the extent that you put restrictions on capital flows, whether it's capital controls, or they inevitably, even in the short term, do have an impact in the development of domestic markets. Because obviously, one of the essential elements of a deep capital market is the characteristic of liquidity and free movement. In my view, and this is a personal view, not a view of the panel, I think that we have to be very careful with the kind of instruments that are utilized and that may be necessary, to stem the problems associated with capital inflows. I'll stop here.
Okay. Now, let me tell you something. We don't agree on everything. We actually have very divergent views on some things. You can provoke us if you want. We are not provoking ourselves on purposes, even though I'm hearing, I know what everybody thinks, and okay. So it's up to you to ask the questions that would allow the panel to react against each other. There goes Bill Klein with I don't know if, should I take one question at a time or several? I don't know. I will start with one. Let me start with Bill. Okay.
Well, it's a delight to...
There's the microphone right there.
Delight to see faces of old friends and to hear the analysis of your deliberations. Let me remark on what I hear missing, which is Brazil's fiscal policy, Brazil's 12% interest rate. I don't see how you can avoid large capital inflows when you have to have a 12% interest rate and the world interest rate is 0. So it seems to me that that's a good place to start the domestic correction. Let me also question the implicit notion that all of Latin America is becoming highly undervalued and with huge capital inflows. It seems to me that we used to think that a 3% current account deficit is appropriate for countries that are developing and have a higher return to capital. So I would have thought that the key is not so much to try to avoid appreciation that winds up with 3% deficits, but rather to pursue the kind of things you were talking about to make sure that it doesn't get disruptive, whether it's, various banking supervisions and so forth. But let me specifically ask about the credit controls. I mean, this sort of sounds like quantity versus price approaches. And we, and most of you on the panel, I think, have over the years become suspicious of quantity approaches. So I'd like to hear a little bit more about how this is different. How you avoid, I mean, do you tell every bank that it can only have an X% increase in its assets? And if so, doesn't that reward the dinosaurs and discourage, the new guys? Why isn't it more efficient to do it with more standard approaches of capital requirements? And is this sort of, echoes of IMF, monetary theory of the balance of payments? If you just stomp down on credit, you won't have a current account deficit, and isn't that a little less suspect?
Okay, first, before asking some of the panels to answer some of the questions, let me tell you that we've been debating also that perhaps in the future we should sometimes focus on a given country. Like let's, say Brazil, for example, and let's take it and, go precise on policy for that. We didn't that this time, but I take your point. But Pedro, do you want to? No, that's okay. All right. So maybe I would like Carmen to answer the question on credit caps, and then I'll ask Guillermo. Do you want to go in Brazil, or well, I can do some Brazil. You can do some Brazil. You want to do Brazil? Yes. No. Yeah.
On the issue of Brazil, what can I say? When you have interest rate differentials of that order of magnitude, they are a magnet for capital inflows. As Liliana highlighted, the Brazil problem is the Brazil problem as opposed to the more general regional problem. That's why, there were not more statements on the use of sterilized intervention. For example, sterilized intervention is not just in the Brazilian case now, but historically also has been a double-edged sword in that you're buying low yielding debt, issuing high yielding debt, and promoting a persistent and chronic interest rate differential that is a magnet to flow. So yes, appreciation. More appreciation, less sterilization are part of the package. Fiscal, we did not focus again on the fiscal because we wanted to specifically focus on credit issues that are more common. I would say a more common problem across the region. On the quantitative versus price, you can ultimately introduce very elaborate provisioning, capital, reserve requirements, all these factors. But in the end, if you still have credit growth of the orders of magnitude that we are seeing, it's bound to be the case that you're lending to the more marginal borrower. I don't think the issue of crowding out this great entrepreneurs is something that is particularly a major concern. I think the concern that we're dealing with is one that as credit booms grow old, you begin to lend to the more marginal and marginal borrower. We saw this in the subprime crisis in the United States. When you look at the quality of mortgages made in 2006 and 2007, they were far inferior quality than the earlier mortgages. And that's just, I'm using that as an illustration, but that is a common theme. It's good to be fashionable at times and say, well, quantities are very blunt and so on. But the fact is, a lot of the provisioning, a lot of the more subtle approaches just haven't delivered when it comes to slowing down overheating.
Again, that's a very important question, Bill. I agree, quantity versus price. The thing is, we are living in a period where when you ask investors around, they don't know what's happening. There's a lot of uncertainties. So the fundamentals are not there. The fundamentals that we as analysts, as policymakers can understand. And on the basis of that, determine a price, say, policy. It's very hard because we don't have a demand function. They keep shifting all the time. So when that happens, a price policy may be effective, may not be effective because there are shocks that are dominating the scenery, so to say. So when you are in those extreme situations, maybe we want to differentiate between normal situations from extreme situations. One should be prepared, and I guess that's the spirit of what Carmen was saying, because when you see that you are doing everything you can, like in Brazil now, and credit continues going up very fast, you say, well, I don't know anymore, so let me put my finger into what hurts. So it's a sort of not a permanent policy, it's more of a transitory and emergency policy. That's the way I think about it, if you wish.
One more thing on this issue. I think that it's important to realize that the situation is quite different from, say, the 90s as regards to the banking system, where in the past, a problem of the banking system in Latin America is that was not profitable enough. Okay, so we were worried of how to generate the return on equity that one would see consistent with a healthy institution, but this has changed dramatically, and maybe in large part because we have very low interest rates. So today in Latin America, it's not at all uncommon to see profit returns on equity of 30% or more. Okay. And in that case, then it's clear that the capital requirement is not very effective. Okay, simply by capitalizing with your profitability, the bank balance sheet can increase at 30% per year. Okay, and we know that the challenge for any institution, simply in terms of management challenges, managing new risks, procedures, and so on. It's very tough to say, well, in 2-3 years you are double the size you were, okay? And I think that in this sense is where maybe what was the best solution or the best policy a decade ago, in the current situation, it's not surprising that these macroprudential regulations are not so effective, and when one has a macroeconomic objective in mind, maybe we have to go directly to something that looks a little bit crude, but maybe it has more benefits than costs.
Yes. If I could think of a headline in a newspaper, I would summarize what has been said as something like, even though we are very much supportive of traditional policies in normal times, and the headline comes now, traditional policies may not be effective in a bubble. So what we are is in a possible, and we have all the incentive that is not all the indicator that is forming. So should we just go with the status quo of what works and what doesn't work and wait until it explodes in our face and say, oh, you know what, we couldn't avoid it? No, we have time, and we have the tools. So not using them at times sounds silly. And that's why you have a committee like this, which you know most of them very well, that are usually very conservative economists, very traditional, very proposing something that is a little bit, it's not so much actually, but it's a little bit outside of the traditional box of what we ourselves would like to propose in regular times. Teresa. And then after Teresa, I see a lot of hands, so then I'll start taking questions.
First of all, I would like to note that fiscal policy is not only expansionary in Brazil, it's expansionary for most of Latin America at the moment, if you measure it correctly, that is to say, taking into account the cyclical position. So I really would like in future sort of issues and so of your very interesting papers, a little more emphasis on the role that fiscal policy can play in moderating demand, in discouraging very excessive capital inflows. A second point is a small footnote to what Bill Klein was saying. What's wrong with a current account deficit of 2 or 3% of GDP in Latin America? Well, there is something wrong because at the moment, the country is experiencing huge terms of trade gains, which are probably not sustainable forever, certainly not at this pace. And therefore, the deterioration in the current account balance is a lot larger than what it appears simply comparing, to before the crisis and now. And finally, on the quantity versus quality versus price mechanism, I just would like to remember that in Europe, when I used to work on Europe in the 70s and 80s, there was such a thing as l'encadrement du crédit, in France. It was pretty much the same mechanism. I think it would be worthwhile looking back at the experience of those times and seeing how these credit controls can be easily circumvented. So it's a temporary measure. It's a measure that is not without cost, as Guillermo Ortiz pointed out, in terms of the development of capital markets. It should be temporary, and more effort has to be made at putting the fundamentals right. Thank you.
Okay, let me collect more questions because I have a number of hands. Nancy? There's a microphone.
I wondered if you could say a little bit more about this issue you raised of protecting the foreign, when foreign banks are under duress. You kind of, I didn't quite get it. You seem to be saying, well, we don't want to discriminate, but maybe we have to discriminate. So if you could explain a little bit more about that. And then I was just curious about the excellent idea that it's not sensible to keep subsidizing debt, including the issue of the mortgage interest rates, because that's obviously something that ought to be on the agenda in the U.S., but the politics are very difficult. So I thought it would just be, and it takes a long time. So this is not going to deal with your immediate problem. It's part of the fundamentals.
That's why it's in the statement, it's under structural.
Right, it's under structural. But it just would be interesting to hear if any of you have anything to say about what is the political possibility, given how impossible it looks here, once it's locked in for such a long time. I don't know how long it's been prevalent and who's really benefiting. It must be people who have more influence on policy than people who don't have influence on policy in most countries where it exists. Then just to say, because Teresa is a fiscal, she's an aficionado of the fiscal. So, of course, she raised the issue of fiscal. But I think those of us who, next time, if the CLAAF could go back or go to really what is the problem in Latin America that doesn't seem to be getting overcome, even with more rapid growth, that there's still that problem on the fiscal side, that it's so difficult to get on top of it.
Thank you. Jordi Zamora from Agence France Presse. 2 quick questions. You said at the beginning of your speech that you don't, as a committee, you don't forecast a crisis in the region, but I would like you to comment on the possibility of a non-agreement on the debt issue here in the United States. What could be the impact for the region? And the second one, you were mentioning that yesterday as an example of the imbalances and the surprises that the markets are still showing us in the region. Yesterday also we have the outcome of the Peruvian election. I'm not asking you, of course, to comment on the Peruvian election, but given the political landscape in Latin America, which is quite leftist, and yesterday was a further step, how likely is that those governments are going to coordinate and put in place the measures that you are asking for? But some of the measures are very interesting because they could go along very well with the leftist government, but some others are completely, I think, against the political trend. So how likely is that all these measures could be applied?
Hi, my name is Pablo Federico. So I have the view that the same externality that is producing banking institutions to take maybe excessively liquidity risk in these times in Latin America might be making them invest in the asset side in credits to consumption, to, let's say, blenders, TVs, etc., and not investment that go to expand long-term capacity as electricity generation. Do you have a view on if we need to attack the first type of credit as instead of attacking the entire asset side of a balance sheet that might hit what is arguably very low in Latin America? There is investment in capacity expansion.
Okay, I think we have, is there any question that I didn't take? Okay, I didn't take your question. It's coming,
Ted Truman at the Peterson Institute for International Economics. I have two questions. One is it'd be interesting to have some of the panel talk about how the two classes of recommendations fit within the debate about the broader debate. Right? So one thing I hear you saying so you have some fiscal structural characteristics, which would be consistent with the view that if you have problems with capital inflows, you need to worry about your structural problems, including in the fiscal area, right? And that's sort of what your story is. But you, Liliana, didn't quite put it that way. So the question is whether I got it right. And then you seem to actually agree with the sort of the broad thrust of the consensus on sort of controlling financial movements, which says, well, in the extreme, you have to do extreme things. And you actually want to do extreme things which are, which I think characterizes most of your recommendations, that are of a national treatments basis, right? Non-discriminatory in terms of the, to be clear, that's what it is. But I want to pin you also down on the credit controls question, right? So what I hear you saying, though it may be because there's some nuances on the panel, otherwise why it's not that clear, is that in the extreme you could use capital and you could use pro-cyclical reserving and you could do those kind of things, which are sort of semi-traditional macro-prudential type things, increase market requirements and so forth and so on. So those are semi-conventional macro-prudential measures, right? But in the limit, at some point, you would say, you would go institution by institution and or credit class by credit class, right? And the question is whether that's the right reading of what you would say. So you would impose this comes to raise this question about you would impose limits on financial institutions, expansion of their balance sheets. Of course, it'd be nice to know how you would define the limit. Is it 30% expansion of gross credit, or is it 13? Those are my questions.
Okay, I think we have plenty of questions here. Anybody wants to take a question?
There were a lot of questions, but let me take Nancy's question on foreign banks and the presence of foreign banks in emerging markets, and particularly in Latin America. This crisis showed that the world is upside down. In the financial stability board discussions prior to the crisis, of course, the cross-border issue regarding banking was to what extent was a parent bank responsible for failures in the subsidiary. That was the main theme, and that was what the discussion was about. The world turned upside down because during the crisis, of course, it was the home banks that were disrupted, while the subsidiaries of the banks remained in pretty good health. and Mexico is, Chile and all over Latin America, but Mexico is a case in point because of the dominance of foreign banks in the banking system. And what we observe there, of course, is that to some extent, the foreign subsidiaries were actually funding the home country bank. It was cheaper at some point for Citicorp to finance through Banamex in dollars than directly through Citi. But of course, the subsidiaries are institutions which are created by the local jurisdiction, and they obey local jurisdiction, so there are limits to what they can do. In the case of Latin America, I mean, there were no significant, except perhaps for Santander's initial public offering of Santander Brazil, which fetched about $4 billion, which were transferred to to Santander's home bank. And there were, of course, limits to the amount of either funding or capital that could be transferred from the subsidiaries to the home banks. Now, what we are saying here is that in cases where there is bank stress in the home country, the supervisors of the host country of where the banks are operating should be able to place special liquidity requirements on the subsidiary to isolate it from the problem. And this is not something that is uniquely happening. I mean, today, again, Tim Geithner emphasized the need to put additional capital and liquidity requirements on systemically important banks. So this is not unprecedented.
Yeah. Yeah. Just on your little note on what you just said, in the United States, there are lots of policies of this nature. For example, even in New York, the laws in New York give preferential treatment to residents of New York if a subsidiary of a New York bank is outside New York is going to fail or something like that. Okay, so what we're trying to say is that it might look as if some of the proposals, we've never seen them before. No, it's not true. We've seen them in developed countries. Okay? So we are just trying to look at the whole spectrum of policies. Some of them are very bad, some of them are very good abroad, but we are trying to think a little bit out of what we have always been in and, just analyze them.
So just a quick follow-up. So this would be not at the time of a crisis.
No, that would be too late.
It would be now to have different rules or the capacity of a government to, there would be a decision to have a different set of rules in terms of capital requirements or other prudential.
Liquidity only.
Liquidity only for foreign banks. That
Yes.
would be the idea.
No.
All foreign banks,
No, foreign banks who are deemed
systemically important or something.
not only, and to be a potential source of trouble for the subsidiary.
Of course, yeah.
So it is essentially a supervisory power, which is very common, for instance, in the U.S., the stability, we do not have.
It's not like Liliana explained it. It is as someone who used to do this or be involved in doing this, we call it ringfencing.
Yes,
So you say ringfencing. So if you have a foreign bank operating in the United States, right? It doesn't operating in the United States. You make sure that, especially when there may be problems, that this is actually why we knew at the Federal Reserve knew about Korea and the IMF did not. Because a lot of Korean banks operate in the United States, and when they saw the chaebol failing, we said the Korean banks have a lot of short-term liabilities to U.S. residents. and therefore we will insist that those banks have sufficient liquid liabilities so they can meet their short-term liabilities to U.S. residents. And so that's the ring fencing of the centrally liability structure of the you're right, Pablo. Essentially it's a supervisory step, somewhat extraterritorial, if you want to put it that way, in its reach. But and we applied it also to Japanese banks just to make it clear.
I think I'd like to turn to some of the questions that were raised in three particular issues. One is Teresa raised the fiscal issue, fiscal policy. The other gentleman, the issue of the odds of a crisis. What is a crisis? And then the third issue was also raised by Ted and Pablo on what do these credit caps look like. Let me start with the fiscal. Teresa, we are in agreement. Especially during a commodity boom, especially once you adjust those fiscal numbers and those current account numbers for the fact that we have very high commodity prices, we have yet again pro-cyclical fiscal policy. One problem with calling for a reliance on fiscal policy is the notorious delays in implementation. That does. I take the point that that doesn't mean that one should not call for it. But fiscal policy, I mean, we're dealing with very rapid changes in capital inflows. The credit boom is going on right now, and we really, at this conjuncture, can't sit and wait for another year for fiscal. But that is not to say that I do think the pro-cyclicality issue is problematic, and the extent of procyclicality is masked because the booming commodity prices make the indicators look so good. On the issue of crises, we have, as a profession, as possibly as human beings, the chronic problem of looking at the last crisis. And so the last crisis were importantly driven by external indicators, increases in external debt, big current account deficits, were part and parcel, inadequate foreign exchange reserves to meet maturing foreign currency debts. This is something that Guillermo has been writing about for years, inadequate coverage. That's one type of crisis. That's the crisis of the mid-1990s in Mexico, 97, 98 in Asia, and so on. But that's not the only kind of crisis. To have a good old-fashioned banking crisis, you don't need the credit to come from abroad. You just need poor lending decisions on a large scale, which is precisely what we're concerned about here. So the fact that a lot of the external indicators look sound shouldn't be taken for complacency. And lastly, on the issue raised by Ted and Pablo also, as a group, we only talked about caps on credit growth without getting into, a lot of the micromanagement. That's a, slippery slope. Countries like Indonesia and Malaysia in the past have gone out, Pablo, and imposed caps, very tight caps on consumer lending, for example. But that is a step, as I understand it, unless I'm misrepresenting the group, a step further than what we discussed, just, for clarity.
Right. Yeah, this is important, right? These are ideas that for the first time as a group, we have agreed to put forward. So we have not gone into detailing the nitty-gritty of the policy. That would be perhaps the next statement or something like that, where we take one policy. It's just that we found ourselves asking, well, yes, okay, we've been suggesting what everybody else been suggesting for a long time, and nothing has been happening, even though we've been shadowing the same evolution. So let's put forward things that we agree, and then we can develop them further. Guillermo, you want to add something? No? Pablo?
Yeah,
And then Roque?
I want to agree completely with what Carmen was saying. Just as a thought on the issue of caps. Sorry. What we think about caps is really that the growth in the asset side of the balance sheet is applied bank by bank, but it's a number that is the same for every bank. Okay, no differentiation across banks. I'm skeptical of the idea of using caps on parts of the balance sheet. I think that on the side of implementation are much easier to circumvent. Okay, and in a certain sense, the simplicity and the macro objective of the cap of the general cap, I think. I find it much more preferable to try to use that that instrument to actually try to change the composition and sort of the business that the bank chooses to do. Okay, that I prefer much more a non-quantitative approach. On fiscal policy, I agree with Teresa, of course. It's worrisome that fiscal policy is expansionary in times where commodity prices are at a boom. I think that one interesting issue when one compares the effectiveness of fiscal policy to affect the current account in relation to the 90s, for instance. At that point, there was a lot of discussion whether contractionary fiscal policy would actually generate higher deficits. And the channel was that interest rates, maybe from a more credible fiscal position, would fall because risk premium would fall, and that would result to be expansionary. It is interesting that now spreads have compressed so much that maybe that consideration that was relevant when risk spreads were high today has ceased to exist. I think that and this combines the fiscal issue with the Peruvian election and the issue of populism. Okay, I think that we discussed on Peru, and I can tell you that I'm much less worried about the electoral results in Peru, and I think that it's a mistake to characterize the results in terms of left and right, okay, or in terms of populism and other countries. I think that what matters the most in Latin America is really whether governments and public sectors are professionals or not, okay? I think that you can have a leftist leaning governments, but which take their objectives in a professional way. I think that part of the unnecessary fiscal expansions that we see in Latin America derive from really a non-professional management of government expenditure, and which simply results in inefficiency. You spend much more than what you should to get to reach the objective that you want. So, in a certain sense, I think that my opinion as a non-Peruvian on the Peruvian elections is that I think that Humala deserves the benefit of the doubt, and I think that in the end it may turn to be actually a very good news to Peru if his government turns out to be a good surprise, as Lula has been for Brazil or Tabaré Vázquez for Uruguay, and maybe what this is simply an opportunity to take out from Peru of a risk that is there for basically preconceived ideological
A request for
preconceptions.
the press, write the last statement under Pablo's Guidotti's name, please.
Yes.
Roque.
Yes. Yeah, I will address something that Nancy mentioned with respect to the political support that one could have with respect to the deduction that we have at the present time on interest rates. And we thought about that in our discussion, and what I think that one possibility that we might have is to work in the direction to eliminate the discrimination of funding the corporations more with capital and less with debt, allowing some sort of deduction of dividends. Okay? So I agree with you that we cannot go and discuss a legislation saying we are going to cut to the people the deduction of interest on mortgage or whatever. But I think that we could look at the income tax legislation just to see if we can introduce some modification in order not to penalize the capitalization of firm, because you have to pay, in the case of Argentina, 35% every unit of capital you put in has a gross dividend or net dividend that you capitalize. So it's going to be much easier to distribute dividends, and the taxpayer, instead of capitalizing the firm, they will buy debt from the firm, even the same owners, okay? And so what we want is to increase the capital of the firm, not the debt of the firm. Because when we have this sort of capital outflows and debt become due and they don't have to get credit from some place to pay the debt. So the idea is to go in that direction. The other thing that it was mentioned and in several of the answers it was covered is that I don't think that the problem of the credit caps is price versus quantity, it's quantity versus quantity, in the sense that we have a quantity limitation in terms of any particular bank cannot grow unless they increase their own capital. So you cannot have more credit or more risky assets unless you have an increase in your own capital, because that's the minimum capital requirement. And suppose that we are in a situation where the minimal capital requirement is binding, then any particular institution is not going to be able to increase risky assets unless they increase their own capital. And when we discuss Basel I, Basel II, Basel III, we always paid a lot of attention that the capital requirement is a sort of limit in the expansion of risky assets. But, as mentioned by Pablo and also in the internal discussion, the point is that when you start to look at the capital in any given institution, maybe just by means of accrual of dividends or by several other elements, you can use accounting to increase capital and to increase risky assets, okay? And then this is a micro element that the banking supervision has to pay a lot of attention, so we don't have accounting increasing capital, but what we really want is that the real capital increase, and so that is going to be a sort of co-insurance in the financial institution with respect to the risk that they are taking with the money coming from deposits. So this is the idea of the capital requirement. Well, the point is that the idea is right because it focuses institution by institution in the micro prudential regulation of banks. But the problem that we have at the present time, and was mentioned in the presentation, is that here we have a sort of capital inflow disrupting the macroeconomic environment. So in the same way that you say inflation is something that you have to pay attention to monetary aggregates, then in the same way when we have credit booms and we have bubble, is you have to pay attention to the credit aggregates. So it's a macro problem. And our intention in this statement is to pay attention to these dynamics at the macro credit level. So in that sense, it's quantity versus quantity, that we are looking at the quantity of real capital for the minimum capital requirement versus the quantity of credit that will help or will produce a bubble in the aggregate economy. And in that sense, there is another question that is very relevant for the case of Argentina, that if we look at some sort of credit caps, you have to ask the question, because several countries, they badly need long-term capital. And what we have at the present time is a lot of credit for consumption. And so maybe it's reasonable to think in having some sort of credit cap for one thing and not for the other thing, let's say for the long-term capital. Of course that we are not suggesting anything in this statement, so we are putting some of the question and giving some potential answers to the solution that we think that we must pay attention. But the idea, the fundamental idea that it is in the title of this work, is just looking at the macro impact that we may have coming from financial crisis from abroad, going through the credit channel in the emerging market and producing bubbles and crises in these emerging economies. Yes.
Guillermo.
Yeah, very short clarification. We are not talking about levels.
Yeah.
This is just flows. So it's very far from capital controls. I mean, it's just the pace at which credit expands that we are concerned about. So it's not a major interference with the system in principle. It may be difficult in practice, but it's just the slope of the curve, not the level of the curve.
Okay, well, we are exactly noon. I just want to thank you, all of you again, for joining us. We are taking your comments and questions very seriously. As a committee, we have a great time meeting and talking to you. So the only thing I have to tell you is until next time. Thank you.